morning, everyone. Welcome to round 2 of Crypto Mondays. Today we're going to have Kirk talk about tax stuff, and then we're going to have Jeremy talk about his experience in the Web3 industry since he wrote for Bitcoin Magazine. So it's kind of neat to have different perspectives from both the logical and the creative side of the Web3 industry. And then, of course, I'm Sean. But if you have any questions, feel free to reach out regarding Crypto Mondays or Coin Flask. I also put some flyers around the room where you can scan the QR code if you want to stay up to date with the newsletter. That's where I'll post the recap from all the meetings, as well as future events that we're going to be hosting through Crypto Monday. With that, let's have a round of applause for Kirk, and
thank you.
Let you take it from here.
All right. Actually, Tara, could you do a favor and maybe take a couple pictures there?
You got it.
As we go along. All right, I was just going to do this fireside chat style. I prefer sitting down on this topic rather than standing up. So the topic for tonight is crypto tax chaos debunking the one-time cost basis exercise of IRS Rev Proc 2024-28. I'm sure this is not a fun or desirable topic. It's not actually something that I actually like talking about. I'd much rather talk about DeFi stuff and degen stuff and not be talking about taxes. But since it's an important thing that's coming up with a lot of changes that have happened over the tail end of 2024, this is something that's super important to highlight, which I'm going to get into. And there's actually, we're only down to less than 2 months for some actions that need to be taken here. They're like super important. So that's what I'm going to talk about. So just a real quick before I get started too, just a shameless self-promotion shilling plug, which is CryptoBullseye.zone. Some of you guys have heard me talking about this. It's a crypto education membership site that I've been working on for essentially 2 years that I just launched on. Give me 1 second. Just 1 second. Just to show you this. Anybody, well, I guess maybe I let the cat out of the bag. But anyway, so I launched this specifically because it was very close. And so for those of you know that the Satoshi white paper was, the anniversary of that was on 10/31 this last week. So did a press release on launching that, you know, to give a nod to Satoshi and the Bitcoin white paper on the 16th anniversary. So basically, starting slideshow here. Okay. So basically what I did is we've got 25 courses that are in the that are queued up so far. They all have quizzes and certificates and all that stuff. So the differentiator here is that it's a focus on risk, security, and fraud and scam intelligence instead of the approach most people take was, and what a lot of people want to do, which is like, just tell me how do I get my 100x returns, and they want to skip all the important stuff. So that's really the focus here that I've, you know, after having advised and consulted and educated thousands of people at this point over the past 11 years. And seeing so many people get wrecked, that's really what inspired me to do this, because I've gotten wrecked, but really not that bad compared to, you know, a lot of people that I've talked to and worked with. So in any event, let's move on to this topic here, which is, let's start with how it used to be before January the 1st, 2025, as far as crypto taxes goes. So how it used to work is, or how it works right at the moment, at least until the end of the year finishes, is that you calculate crypto tax based on a universal basis. And I'm sure anybody that's done that with their, you know, most people, or 99% of people probably using crypto tax software that's out there. So you're going to connect all your exchanges, your wallets, and or import manually, and you're going to get all that stuff in there. So as far as the software goes, what it does is it just commingles everything in one pot. So whether you got 29 wallets and 3 exchanges or whatever it is, you just take all the transactions, throw them in one bucket, and do a calculation in one bucket as if it was a single wallet. So if you had Alice and Bob, and Alice just had a Coinbase account, and Bob had, you know, a crazy number of wallets, like say 37 wallets and 4 exchange accounts, centralized exchange accounts, If they had all the same same transactions on the same dates for the same amounts, the same coins, everything was exactly the same. If the only difference was where did it live, as in the wallets and exchanges and everything else, if that was the only difference and everything else was the same, the calculation is going to be exactly the same because of universal basis. Again, you're just dumping everything together like it was just a single wallet. So now what happens is those days are over with. It's now how it will be after the end of this year, which is that universal basis is eliminated, and now we have a wallet by wallet, account by account, exchange by exchange basis. So, and of course, now one caveat is to say here is that when I think about complexity of crypto, whether it's taxes or otherwise, I always think about everything on a spectrum. When I think about crypto on a spectrum, I'm always thinking about it from one end of the spectrum, which is like the degen end, which is people that have dozens of wallets, multiple chains, like stuff's all over the place, right? And the other end of the spectrum will be you got one app, one Coinbase account or whatever, and that's the other end. So I always thinking about it from the complex end of the spectrum when I'm talking about this stuff. So now, again, if you go back to where Bob had, I think I was saying that Bob's got 37 wallets and 4 exchanges. That means he's got to do now 41 little different sets of accountings, if you will. Where before he had one accounting, and now he's got 41 little sets of accounting to do, right? And so basically the deal with this RevProc is that taxpayers now have to do a one-time basis allocation. It's a one-time exercise at the end of the year to set yourself up for next year and going forward. So this is where the conundrum comes in. So as I said, you have to allocate basis per token, per wallet. So some of this might seem obvious, but of course you can't allocate Bitcoin basis to Ether and so on and so forth. You got to allocate Ether basis to Ether, and you have to keep the dates the same as well. You can't. The dates are critical because the dates tie into your holding period. However long you've held your crypto depends on whether you have a short-term or a long-term gain, right? So you have to keep the dates that you originally had. You can't just wipe away the dates when you do the allocation process. So you got to do this for every wallet, every exchange account. And in this case, if you have like a MetaMask where you could obviously just have one account, say one, ETH account, or you could have numerous. Each one of those is essentially a different, each address, if you will, or account that's its own accounting, even though the wallet contains multiple accounts. So now you've given 2 ways to allocate, which is specific unit allocation and global allocation. Specific unit allocation is not to be confused with specific identification, which is another type of cost basis method. This is to add to the confusion. Similar words, but it's distinctly different. This term right here is specifically for this one-time exercise, and that's it. All right, so basically what I would say is a specific unit allocation is like taxpayer's choice, crypto user's choice, like fielder's choice in baseball, right? Ball comes, you go this way, that way to make the play. That's taxpayer's choice. Global allocation is more like what I would describe as a recipe. So that if I make the recipe up and say this is how I want to allocate, right? I call it a recipe or a process, a system. If I give it to Matt or Tara or Sean, Mike, if I give it to you, you guys will all come up with the same, theoretically, you come up with the same exact result, okay? But if you go do specific unit allocation, because I said it's taxpayer's choice, you're all going to come up with a different answer because it's however you want to do it. So global allocation is more like a formula, where specific is just user's choice. And one thing to note here is I'm just really scratching the surface on here. There's all kinds of stuff that revolve around this because you guys hopefully are familiar with the digital asset broker regulations that have been bouncing around through Congress for a couple of years. They finally became final this year, a few months ago. So what I'm talking about here is like a special guidance that came out for this one-time exercise. It wasn't part of the final regulations because what you had is it forced you into this transition period, hence this thing here. So there's a whole world we could dive into. I'm just scratching the surface of all this stuff right here. So why make the allocation? Well, number one, it's required. Number two is you get the safe harbor. I don't know if you guys, I'm sure you guys are familiar with the term safe harbor, but in tax it means if you get into the safe harbor, as the name would suggest, you are in the safe zone. Like you got a force field around you that says you can't be penetrated if you follow whatever the guideline. There's lots of different types of safe harbors, right? So if you follow these guidelines, you're in the safe harbor. You can't be audited. They can't poke a hole in what you did, and you're free from interest and penalties or any recalculation of tax and stuff like that. So, like I said, it's like a free pass from penalties, interest, and recalculations. So, what happens if I don't allocate? Well, then you don't get the safe harbor. The thing is, you have to do this anyway. So, if you don't do it in time by the end of the year, you don't get the safe harbor, but you still have to do it anyway. So, it's not like you get out of it. You still have to follow the allocation process, whether you do it on time or not on time. So that's hence why it's important to get this done by the end of the year. So, or you could get audited, which could lead to penalties and interest or a gigantic tax bill, possibly prior year's recalculation. We don't know because there's a lot of things. So, as is typical with the IRS, maybe many more unanswered questions than there are answered questions. So, right here, the worst case scenario would be like somebody, for example, has low basis Bitcoin, low basis any crypto, right? Low basis or zero basis, meaning, for example, they got ETH at the crowd sale in 2014, and so it's essentially zero basis, meaning it's almost all gain, right? So in that case, you were doing it one way, and if you didn't do the safe harbor and you got audited, they come and can recalculate. You can basically get wrecked. Your entire portfolio could get crushed because all of a sudden they do a recalculation and get this gigantic tax bill simply because this is the way they calculated it differently and you didn't follow some rules. So again, the audit rate is low, but that's not even part of the equation here because the risk is so high. It's best to just follow this procedure here. So, let me show you one thing here. I'm going to give you an example. So I did this is a proof because one of the things is, okay, well, you need to do safe harbor, but they don't tell you how, right? Which is classic. How do I do it? What do I do? What do I need to prove that I've actually done it the way that's acceptable to you? They don't tell you that part. But this is what I suggest would be one way to do it. So I just made this example up here. This is Bob, right? So this is Bob's inventory at the end of the year, okay? Has nothing to do with, this view right here has nothing to do with wallets. All it is just what does he have? That's it. Not where is it, what does he have? And you can see those are the acquisition dates. You see we got ETH, BTC, Atom, and NEAR. Those are the acquisition dates. We got token quantity, cost basis, and then cost per token, etc. Right? Now this is just like a subtotal for ETH, subtotal for Bitcoin, etc. Okay? So now we need to allocate that on a per wallet basis. So we just come on down, and here is his. This is more or less a matrix of another view. So now we got his inventory, but now it's his inventory based on the 5 wallets. So he's got a MetaMask, a Trust wallet, a Kepler, Exodus, and a Coinbase wallet, right? And this is showing where all the coins are, right? So you've got ETH in 3 different wallets, etc. NEAR in these 3, and so on. Atom and Kepler and Exodus. Then coming down here, now he's actually going to allocate based on the wallet. So again, he's got MetaMask for ETH. He's got MetaMask, Exodus, and Coinbase, and he's going to allocate these. And you see how I said he's got to keep the dates have to stay intact. So you have that. And then what this is right here is this is the proof part of the process right here. You'll notice that, see where that comes down to 0? So what this is I'm proving that I've taken everything up top and everything is accounted for fully down at the bottom. And that's what I call a check total, a check totaling to 0, which is a proof that it's accurate all the way through. I don't know if that's making total sense, but like, again, they're not telling you how to do it. This is how I'm saying I would do it, because now I know that I've accounted for everything down here. So then if I keep coming on down, do the same thing again for BTC. Again, check total to 0. I know it's all accounted for. Atom, same thing. And this one, same thing. So this is what I would say is a proof that you've allocated correctly. And then you email it to yourself. Again, how do you prove that you did it? That's one thing they didn't say. How do I prove that I did it? Before you said, yeah, you told me I had to do it before the end of the year. How do I prove it? I don't tell you. So that's the example there. And if I just go back to here, so again, I'm just scratching the surface on some of this stuff, trying to give you some high-level points here. What's our time check? How much time we got? I'm close. I made it so it would be short, but I just want to, okay. So the question is like, first of all, I'm going to show you. I got some resources here later on, but I've written a lot of blogs on it. Not just this topic, but the whole digital asset broker thing. Written a lot of blogs like IRS kills crypto, IRS kills DeFi, and so on. I've done a lot of material on this. So it just makes me go insane to think that they basically, it's like the way the IRS spins it is we've made it better for the taxpayer so they can complete their taxes easier. And I say it's the opposite of that. One of my other blogs is how the IRS just tripled your tax prep costs by doing this stuff. And if this is a one-time exercise, that's going to be a special bill if you actually had to hire somebody to do it. But whereas they assert, of course, how it's better for them is it's because they're trying to put their finger on they're trying to squeeze you because they think that there's a tax gap. In other words, they're not collecting taxes on crypto. So that's why they came up with all these rules to get brokers to now submit forms the same way you have with your TradFi broker where you get your 1099-B. They're trying to do that with crypto now with at least the centralized exchanges to start with. That's going to be an absolute complete nightmare, in my opinion. There's going to be a perpetual mismatch between what you have in your track software records and what the broker has. In most cases, it's not going to be the same. It's going to be a mismatch. I could go on and on about how crazy this is. It's an absolute nightmare. So anyway, since you have it to deal with, the question is how do you make it, what's the best case scenario? How can you make this work the best for you? One of the ways is, these are just like 3 strategies, is remove crypto from all exchanges, because otherwise you're going to have a perpetual mismatch problem. And I know everybody saying here, well, why would you say, why do you have crypto on a centralized exchange in the first place? There are reasons to do it. There are some reasons, some good ones. But, regardless, if you have any crypto on exchange, take it off, because I said whatever basis they have is not what you have. That's the perpetual mismatch. So if you take it off, wait till the end of the year, and if you want to put some back on, it'll cleanse it. It's what I call cost basis cleansing. It'll cleanse it because then they're going to have a zero basis for you. And it's better that they have a zero basis is not accurate either. But my assertion is zero basis is better than a number that they have that's wrong. It's better to have zero than some other number. Because then if you explain it if you come in and say, well, this is what it really is, I think it's better for you to say this is what it is because they said zero. Like it's just a better scenario. You look better, right? So that's why this is one cost basis cleansing. Remove the crypto from the exchanges, put it back again, and then they're going to basically have a zero basis. The same thing as a transfer, even later on, like in 2025 and beyond. If you transfer from any wallet or exchange into an exchange, they're going to have a zero basis because first of all, they don't know what it is anyway. There's no way for them to know. Some of these, there's actually some of the exchanges that it's not a requirement. Some exchanges may accept user-provided cost basis, but it's not a requirement. And to me, they're not motivated to do it because all they're going to do is inherit a big giant problem where people say, oh, this is my cost basis. A month later, oh, no, it's wrong. I gave you the wrong number. And then they're going to have to set up a whole department to deal with, customers' problems who, they can't manage their data right and they don't even have what the right numbers are. So anyway, consolidate one token to one wallet. So if possible, get all your ETH down into one resting place, all your Bitcoin in one resting place. And perhaps it could even be the same wallet, like one wallet, all my coins. I know, that's why we have different wallets because they don't all support all the tokens, but you get what I'm saying. That's theoretical. In practice, it wouldn't happen that way. But again, taking if Bob could whittle it down from 37 wallets down to 4, he's obviously, I think you could see how that's going to be a lot less of a headache trying to do cost basis allocations in 37 places instead of 4 places. So whittle it down, consolidate. Also remove LP positions and similar positions. So the reason for that is it could also be staking. So for example, like Cosmos, you stake your atoms. Any of the assets in Cosmos, they have from a 14 to a 28-day bonding period. Typically 21 is actually the most common. So if you wanted to consolidate and you wait until like December the 15th and you go unbond, it's not going to unbond until January. So you need to now you got just enough time to unbond so you can move the assets around and consolidate it all. So LPs, what I found crypto tax software is one of the things is it's just they've all got deficiencies. It's like what's the lesser of the evils? They've all got issues. They've all got limitations. So I haven't found one yet that tracks LP positions and stuff like that, complicated, complex DeFi accurately. So if you're going to try to go do this allocation and you got one of those, you got a pair, it's not going to work out. So I'm saying undo all that. Now again, you might say that doesn't work for me because I'm going to miss some reward or something like that. You got to make the judgment call. But anyway, I say so. Basically, you can see what the thing is: move the stuff around, cleanse, consolidate is the key. Remove positions to get it back down to just to the single asset. Here's resources. This is for those of you that I'm sure this is probably not many. You want to go actually right to the source. RevProc 2024-28 AICPA comment letter, and this is what I've actually worked on that there. So I've been involved with the digital asset task force of the AICPA since 2018. So I've enjoyed that because I've basically been at ground zero for all these things that have happened in crypto and tax. So if you want to look at the comment letter, that would probably be a better read there because it's like 3 or 4 pages. But if you want to see what all the problems are, it lists out like, what about this and what about that? And if you just want to take this one topic right here, there's about like 10 of us in this group. So you got 10 CPAs, and they're like, oh, I've read the thing 4 or 5 times now. I used to think I knew exactly what it meant, and now I don't. I thought it was clear, now it's not. I thought I understood it, and now I don't. And everybody's saying the same thing, and they've been through the thing 4 or 5 times, so you can see how hard it is to navigate this stuff. I also did an interview on the AICPA Tax Odyssey podcast, so if you want to hear me talking about some of these conundrums, that's there. And then, like I said, I didn't even put all the blogs on here. This is a blog about it here. This is another blog about it here. And like I said, I got those ones: how IRS kills DeFi, IRS kills crypto, how the IRS just tripled your tax prep costs, and so on. If you go here, if you just go there and put your email and your name in there, I'll send you this deck here and that worksheet, that proof that I was talking about. So as always, your goal is to get a crypto bullseye. So any questions?
Like you said, like all the CPAs can't figure this out as it is. So have you ever seen like an audit with any of this stuff? Because I'm like, I've always like wanted to see an audit of something that has like 50 different wallets across a bunch of chains with LP positions. Like, would they have any clue what to do with that?
I don't think they might think they do. I don't think that they would. And well, yeah, well, I mean, like I talked about, like a lot of the software has limitations, and they've got a couple preferred software providers that they're using to redo it. Like, here's the thing: who's the best person to do this? You. There's no one that's ever going to know all this stuff better than you do. And even in that case, it's a struggle to even get it figured out as the best you can. So yeah, I mean, but I know one particular case. It's not. I mean, I guess you could call it an audit. It would actually taxpayer basically brought attention to themselves unnecessarily, and because there was some really big dollars on the line, and so they got audited. I said, dude, you need special forces. You need a tax attorney. So we rounded up the best guy that specializes in crypto and tax controversy, and there's not that many of them. And after 2 years, the case is finally cleared, and so I guess he paid some fines, but it worked out to be a pretty favorable scenario. But basically, what I learned out of it is that they're not playing nice, and they weren't out professional. They meaning the IRS Special Investigations Unit people on the phone with the tax attorney. Like, if you got professional, you got professional respect. And what I heard was they were not playing nice. They were like kind of condescending and belittling to the tax attorney. He said he was so bent out of shape. He's like, I'm going to figure out who their manager is because you can do that. I'm going up the chain. I'm going to call the manager and tell him about this. This is not acceptable. So it's one thing to, I guess, do things the right way. And then, it's another thing if you're dealing with people who aren't playing, as my dad would say, that's a dirty trick. So I guess that's what I'd say about that.
As far as the IRS taxing, having to tax you, I understand that you will still, even if you don't send your money to a central exchange and then withdraw it to your bank account, you're still going to get taxed on whatever gains you have. Is that true, or will you only be taxed on it when you withdraw it from the centralized exchange?
No, it's whenever you have a disposition. That's it.
What do you mean by that?
A disposition is selling one asset and buying another one. So it don't matter whether it's fiat or crypto to crypto, crypto to fiat, any of that stuff. Whenever there's a disposition event, that's what triggers it.
You will be taxed.
Yeah.
You're going to get taxed on that.
So.
Like this is a year by year situation. Another concern that I've heard from the state attorneys is their nightmare of gathering all information, especially crypto, as their clients are holding crypto in their estate, of how to handle the taxes with the executives or like the executive of the estate after somebody passes. Like, is IRS handling a protocol for that at all?
Yeah, that is obviously a challenge. Well, there's other challenges. One of the big challenges with the states is, did you actually set the crypto up to be, for the custody to transfer? That's a separate issue. But yeah, you could have one where just the records are gone somehow in that way. But yeah, it's another challenge. You really don't hear too much about estates with crypto as far as crypto and tax. A lot of people talk about it, because it's like, if you die, your keys could die with you, like that type of thing, like legacy planning. It's not just it's also business partners. It's not just husband and wife or what spouses and stuff.
Does anyone else have any other questions? No? Awesome. So thank you for your insight.
All right.
Appreciate it.
Thank you, sir.
And if anyone needs to get in touch with Kirk, you gave him the link, right? And I'll also post that online as well, so you guys will be able to get in touch with him if you have any additional questions. Now we're going to have